Warm greetings to everyone. My name is Dharani KS and today I'll be discussing about the corporate actions on Industrial Credit and Investment Corporation of India, which is nothing but ICICI. In today's agenda, we are having introduction to ICICI Bank. We'll be discussing about the corporate actions and dividend payout in detail, and we'll also be discussing about its types, frequency, some of the important dates, important terms, and its effect on stock market. Finally, we'll also be discussing about the dividend payout of ICICI Bank. ICICI Bank is one of the largest and well-renowned bank in Indian banking sectors. It was founded on 1955 as a joint initiative of World Bank and the Government of India. Later on, in 1994, it was transformed into a bank and got approval from the Reserve Bank of India. In 2002, it was merged with ICICI Limited. In 1998, ICICI Bank launched India's first internet banking service, and it is also the first Indian company to be listed in New York Stock Exchange in 1999. It is the largest private sector bank in India by market capitalization, and it is the second largest bank in India by assets. ICICI Bank IPO was launched on June 20, 2007. It is a successful IPO. Its price band was set at 885 rupees to 950 rupees per share. It led to oversubscription at the time, and it was also one of the largest IPOs at the time. This successful IPO led to the strengthening its position as one of the India's leading private sector banks. Now, what are corporate actions? Corporate action is nothing but an event which is initiated by a public company that could bring an actual change to the securities, equities, or debit. Corporate actions are typically agreed upon by a company's board of directors and authorized by the shareholders. There are two types of corporate actions, which is mandatory and voluntary. Mandatory corporate actions are those that shareholders must take action on. On the other hand, voluntary corporate actions are those that shareholders may choose to take action on or might not. Some of the examples of corporate actions include stock split, reverse stock split, dividend, right issue, bonus, merger and acquisition. Now, we'll be discussing about dividend payout. First of all, what is meant by dividend payout? The main motive of every company is to make profit, isn't it? Thus, hard-earned profit might be used for future expansion, or a part of the profit might be given for the shareholders as the return on investment. This distribution of certain portion of company's profits to its shareholders is known as dividend. This is given to the shareholders as the return on investment. There are three types of dividends: cash dividends, stock dividends, and property dividends. Cash dividends are the dividends which is most common and it is given in the form of cash, whereas in stock dividends it is given in the form of stocks. In property dividends, it is given in the form of either properties or assets, which is a rare case. Speaking about the frequency, it is either at the end of the year or during the year. If it is given at the end of the year, it is called as final dividend. If it is given during the year, it is called as interim dividend. Further, the interim dividend is classified as quarterly and semi-annually. In case of quarterly, it is paid every 3 months, and in case of semi-annually, it is paid every 6 months. And in case of final dividend, it's usually paid once in a year. And the most common form is final dividend. We must know some important dividend dates. They are declaration date, ex-dividend date, record date, and payment date. The declaration date is the date of approval of dividend rate by the board of directors of the company. And the record date is the date at which the record of all the shareholders who are eligible for getting the dividend is taken out. And the shareholders must hold their stocks in their demat account in order to be eligible for getting this dividend payout. The come dividend date is the last date to buy shares in order to be eligible to receive dividend, and it is usually one day prior to the ex dividend date. And the ex dividend date is usually one day prior to the record date. On this day, the price of the equity share of the company gets adjusted for the dividend payout value. And finally, the payment date is the date at which the payment for the respective shareholders is made based upon their shareholding in the terms of dividend payout. You must also know some important terms in dividend, and one such term is dividend payout ratio. The dividend payout ratio is calculated by dividing total dividends paid by the net income and multiplying it by 100. And one more important term is dividend yield. It is calculated by dividing dividends per share by stock price multiplied by 100. This image clearly shows the effect of dividend payout in the stock markets. At the time of announcement date, the stock rises by the amount of the dividend, and during the ex dividend date, it drops by the amount of the dividend. And if you buy on or after the ex dividend date, you will not be eligible. And even if you sell before the record date, you will not be eligible for receiving the dividend payout. So you have to be strict with these constraints. Let us now look into the dividend payouts of ICICI Bank. Here I have mentioned the data from 2013 to 2023. It is also mentioned the announcement date, the ex dividend date, the dividend type, and the dividend percentage, as well as the dividend amount in rupees. So if you take 2022, the dividend rupees was rupees 5, and it is mentioned like 250 percentage. This 250 percentage is calculated based on the face value. The face value of ICICI at 2022 was 2 rupees. So 5 rupees is 250 percentage of 2 rupees. So that's why it is mentioned as 250 percentage. Respectively, it is 400 percentage for 8, 100 percentage for 2. So here it is mentioned all the details from 2013 to 2023. I have also mentioned the record date as well as the type of the dividend payouts which is made. As I've already said, the most common type is cash dividends. Cash dividend is where cash is given in form of dividends. This displays the dividend yield from 2013 to 2023 for all the dividend payouts made by the ICICI Bank. And the reason was 2023, and it was like approximately 0.82 to 0.83 percentage. For the last recent financial year, that is March 2023, ICICI Bank has declared an equity dividend of 400 percentage, that is 8 rupees per share, and it has also given a dividend yield of 0.83 percentage. And these are all the values which is after the dividend payout. I have also given a bar chart which is plotted between the ex dividend date and the dividend amount. You can see the variations over the bar chart. I also created a graph between the ex-dividend date and the dividend yield percentage. Dividend payout is an important corporate action for a company to make. There are a number of factors that companies need to consider while making this decision. They include profitability of the company, cash flow of the company, future scope of the company, and so on. Dividends can be a valuable source of income for the shareholders too. By looking at the previous stats and graphs, it is clearly evident that ICICI Bank has a relatively stable dividend payout ratio over the past 8 years. ICICI Bank's dividend payout reflects its stability and profitability, making it an attractive option for income oriented investors. And that's all about dividend payouts. Thank you.
Good evening, everyone. My name is Aditya Parashar, and I'm here to enlighten you on the corporate action, merger and acquisition. So let's start. Who controls mergers and what's the difference between these two? It's clearly visible in this slide. They are controlled or regulated by the apex financial authority of the country, and for India, it's RBI, of course. Now let's see the one of the notable merger between the ICICI Bank and Bank of Rajasthan, dated 2010. Profile of the bidder, which is of course ICICI Bank. At the time of the merger, it has three previous merging experiences. First with Bank of Madura, second with ICICI Limited, and third Sangli Bank. There are some history-related snapshots of ICICI Bank. At this, we can see here the size and distribution of the ICICI Bank at the time of merger, that is at the 2010. It has a business of 38,32,222 million, with per branch business of 304 crore. Profile of the target bank, which is of course Bank of Rajasthan. It started its operation in year 1943, and it has a branch network much less comparison to ICICI Bank, only 466 branches, and its employee base of 4K. Efficiency: Bank of Rajasthan reported a net loss of 102.13 crore in the year just before the merger. There are some important dates of the merger. You can see out of these, three of the dates are very much important: 18th May, 23rd May, and 12th August. And day when newspaper came out with the news of merger, the 23rd May meeting of board approved the merger, and on 12th August, merger was approved by RBI. Here you can see the article dated 18th May. Analysis of the merger. I use certain criteria to analyze the merger. First one being deal value. Here, ICICI Bank approved the merge with the Bank of Rajasthan on 18th May at a swap ratio of 25 is to 118, which means 25 shares of ICICI Bank for 118 shares of Bank of Rajasthan. The deal gave ICICI Bank a sizable presence in the northern Rajasthan as expected. It was a no-cash deal, and the value of the deal was 30.41 billion. Here we can see in the data, in this given data, the market capitalization column is one of the most important column. You can see ICICI Bank with 889.35 crores, and Bank of Rajasthan with 99.5 crores. This is the only factor which determines the swap ratio of the two companies when they combine. Second criteria being profitability ratio. It is a measure how profitable a company is, and by comparing its profit to its asset sales or equity. And here we use three sub criteria: net profit margin, return on assets, return on equity, and we compared it pre-merger and post-merger, and we can easily conclude that the post-merger financial performance is high or better compared to the pre-merger financial performance of the profitability ratios of ICICI Bank Limited. Here is the third criteria, growth ratio. Growth ratios is a measure how quickly a company is growing by comparing its financial metrics over time. Here we again use two sub criteria, EPS and DPS, earnings per share and dividends per share, and compared it with pre-merger and post-merger. And again we saw that the post-merger financial performance are higher or better compared to the pre-merger financial performance of growth ratios of ICICI Bank Limited. Let's see, EPS. It was 34.84 in 2007-8. It increased to 36.1 in 2010-11 post-merger, and after that it kept on increasing subsequently. Fourth one is swap ratio. We all know what swap ratio is, but here in the data we can see the price of the share of both the banks before the merger, on the day of merger, and after the merger. Bank of Rajasthan saw subsequently increase in the price, but ICICI Bank saw a dip in their shares, which was for a slight period of time. The final and the last criteria is net worth ratio. Is the ratio of its net worth to its total assets. It is a measure of the company's financial health, and it is calculated by dividing the company's net worth by its total assets. Here we can see the data again pre-merger and post-merger, and graph related to it. And from the graph we can see that the merger affected the net worth of the ICICI Bank a lot in the year 2010 and 11, because we can see the dip there. And after the merger shock recovery, ICICI Bank again we started to see increase in its net worth ratio. And at last, we can conclude that merger is very helpful for both of them. The weaker bank survives after the merge, and the financial performance of the larger bank gets increased, whether it's in the terms of net worth, profit, growth, anything. And we can see some of the other mergers of the ICICI Bank here below. Thank you.
So good afternoon everyone. I am Aditya Singh and I have been allocated with the company ICICI Bank. So first of all, we would be discussing what is share buyback. So first of all, we would discuss what is share buyback. So share buyback is a process where a company repurchases its own share from its shareholders just to demonstrate that the company has sufficient cash reserves. The company gives an offer to its shareholders at a particular point of time at a particular price, which is generally higher than the prevailing market price. The next topic which we would be covering is how can one bid for this buyback share. So the buyback of shares takes place via tender offer or through an open market offer. As far as tender offers are concerned, the existing shareholders opt to take the offer put forwarded by the company, which is done on a particular period of time on a record date and in exchange for some cash offered by the company. On the other hand, an open market offer allows the equity shareholders of the company to participate in this buyback process, which is being done only in the period of time when the buyback window is open, and which can be done only through a stockbroker. The next topic which we would be covering is what are the features of this buyback share. So first of all, we would discuss what is the purpose of this buyback share. So the buyback share allows a company to regain control of its shares by repurchasing the shares from its shareholders. It also helps a company to reduce the quantity of shares held by the general public. Buyback share allows a company to consolidate its ownership and improve its valuation. There are some benefits of this buyback share. Buyback share allows a company to increase the value of the shares and in turn to improve the overall valuation of the company. Along with fastening trust among investors, these are also tax effective way of rewarding the investors. But apart from these benefits, there are some disadvantages too of this buyback share. The major disadvantages and drawback of this buyback share is that they give a false illusion that the company valuation has increased. Similarly, the reduced supply of shares, even when the demand is high, can drive the prices of the shares up, which could create a false illusion to the investors. So these are the disadvantages of this buyback share. So thank you.
Hello, my name is Harsh Chaudhary and my topic is FPO of ICICI Bank. So let's start. Here we will talk about what is an FPO, why ICICI Bank is doing an FPO, benefits of FPO, ICICI Bank's financial performance, risk and challenges. So let's start with introduction. ICICI Bank is one of the largest private sector banks in India and has been a leader in the banking industry for many years. The decision to do an FPO is a significant one, as it will have a major impact on the bank's future growth and success. In this presentation, we will explore what an FPO is, why ICICI Bank had decided to do. So, first we will talk about what is an FPO. A follow-on public offer (FPO) is a type of public offering where a company issues additional shares of stock to the public after it has already gone through an initial public offering (IPO). So, why ICICI Bank is doing an FPO? ICICI Bank, one of the largest private sector bank, has decided to do an FPO to raise capital of growth and expansion. The bank aims to use the funds raised from the FPO to strengthen its balance sheet, support its lending activities, and invest in technology and digital infrastructure to improve customer experience. Benefits of FPO for ICICI Bank. One of the main benefits that ICICI Bank will gain from doing an FPO is access to large pool of capital. This will allow the bank to fund its growth initiatives and expand its operations in new markets. For example, the bank may use the funds raised from the FPO to invest in technology and innovation, which can help it stay competitive in the rapidly evolving banking industry. So, what are the benefits FPO for investors are? Investing in ICICI Bank's FPO offers a unique opportunity for investors to become part owners of one of India's leading financial institutions. By purchasing shares in the FPO, investors can benefit from bank's strong track record of growth and profitability, as well as its commitment to innovation and customer services. ICICI Bank's financial performance. Over the past few years, ICICI Bank has shown consistent growth and improvement in its financial performance. In the fiscal year 2020, the bank reported a net profit of INR 12,000 crore, which was a significant increase from the previous year. The bank's total income also grew by 17% to reach INR 77,000 crore. The risk and the challenges. One of the main risks that ICICI Bank may face during the FPO process is market volatility. The stock market can be unpredictable, and fluctuations in the market can affect the demand for the bank's share. Another challenge that ICICI Bank may face during the FPO process is competition from other companies. There may be other companies that are also doing an FPO at the same time, which could lead to a crowded market and reduced demand for ICICI Bank's share.
Welcome everyone. Today we're talking about the corporate action, stock split. We'll be doing a real life example of ICICI Bank. But wait, what exactly is a stock split? Well, a stock split is a corporate action where a company divides its existing shares into multiple shares. The ratio can vary, but the overall value remains the same. Let's try it with an example. For example, ICICI Bank splits its stock in the ratio 2:1, and one share has the value for about $100. And if it's divided in 2:1 ratio, the same guy who had the stock for one stock for $100 will now have two shares of $50 each. In case of ICICI Bank, there have been two major stock splits. On December 9, 2014, there was a 5:1 stock split. This means that for every one share owned prior to that date, the shareholder would receive 5 shares after the split. And secondly, on June 19th, 2017, there was a 11 is to 10 stock split. This means that for every 10 shares owned, the shareholder would receive an additional 1.1 share after the split. As a result of this split, the number of shares increased and the share price decreased proportionally. Investment growth. Let's say you invested about $10,000 in ICICI Bank in 2013. If you reinvested the dividends, your investment would have grown to about around 55,000 by 2023. This is around 450% increase. On average, your money grew around 18% per year. Your investment in ICICI Bank did really well over 10 years. It's a good example of how investing in stocks can help your money grow over time. Stock splits are like a company's way of refreshing its appearance. Lower share prices can attract a broader range of investors. In ICICI Bank's case, the stock split showcased management's confidence in future growth, potentially influencing investors' sentiments. So, what's the key takeaway? While stock splits don't directly alter a company's fundamentals, they can have a huge impact on how investors perceive and engage with the stock. And that wraps up our entire journey into the world of stock splits and how they have impacted ICICI Bank's shares. As we conclude, remember that behind the numbers and ratios lies a dance of psychology and strategy. Until we meet again, keep your eyes on the market.